Welcome to The Explainer. Today, we are going to tackle something huge, your financial future. We're going to break down exactly how long-term investing works, step by step, so you can walk away with a real roadmap to your goals. Okay, let's just start with a big question, one that's probably on your mind a lot. What does your financial future actually look like? I mean, when you picture yourself in, say, 10, 20, even 30 years, what do you see? Is it a chill retirement? The freedom to do what you love? It's a heavy question, for sure. And hey, it's totally fine if you don't have it all figured out right now. And if thinking about all that makes your stomach do a little flip, you are definitely not alone. The whole world of investing can feel super overwhelming, right? But that's what we're here for. Our goal today is to just cut through all that noise and replace that anxiety with some real clarity and confidence so you can actually get started. Okay, so let's dive right in. The single most powerful tool you have as a long-term investor, it's not about trying to pick the next hot stock or anything like that. Nope, it's something way more fundamental and honestly way more powerful. And that fundamental concept is something called compound interest. Now, I know that sounds kind of technical, but trust me, it's way simpler than it sounds. All it means is your money makes money, and then that new money starts making its own money. It's exactly like that classic image of a snowball rolling downhill. It starts off tiny, but before you know it, it's this unstoppable, massive thing. And this chart right here, it just shows you the incredible difference. That first bar, that's simple interest. It's fine, it grows, but it's slow and steady. But that second bar, wow, that's the magic of compounding in action. That curve shooting upwards, that's your money not just working, but working for you. It's that snowball effect we were just talking about, building on itself over and over again. So what causes that incredible growth? It's really just one thing: time. That's it. Over a long period, like 30 years, the impact is just massive. And that's exactly why you always hear experts say that starting early is way more important than starting with a ton of cash. Time is truly your greatest asset here. It's your superpower. All right, so we get it. Time is on our side. Now let's build on that with a few simple but really powerful rules to guide you. Think of this as your investor's rulebook. And look, these aren't some big secrets. They're just proven, timeless principles that have kept successful investors on the right path for decades. Rule number one is the classic for a reason. Diversify. You've heard it before, right? Don't put all your eggs in one basket. It's basically that. Think of it like building a sports team. You wouldn't want to rely on just one star player, would you? No way. You want a whole team working together, so if one has an off day, the others can pick up the slack. It just makes your whole portfolio way more stable. And here's a quick look at what that might actually look like in practice. See how it's a mix of different things: some US stocks, some international ones, some bonds. By blending all these different assets, you're building a much more stable foundation. So if one part of the market has a bad year, hopefully another part is doing well enough to balance it out. Okay, rule number two. Now this one might actually be the hardest one to follow because it's all about your own emotions. The market is going to have ups, and it's definitely going to have downs. You're going to see scary headlines that make you want to panic and sell everything. But your job, your only job, is to just stay the course. You got to trust the long-term plan you made. And I mean, this quote from Warren Buffett just nails it, doesn't it? The stock market is a device for transferring money from the impatient to the patient. It's so true. Long-term success isn't about knee-jerk reactions. It's about having the patience and the discipline to let your plan work over decades, not just days. And last but not least, rule number three. This is a super practical one that can literally save you a fortune, and it's this: keep your costs low. See, every investment has fees, and even a tiny little percentage can have a massive impact over time. That 1% fee, it seems like nothing, right? But over 30 years, it could eat up almost a third of your potential money. That's huge. So you've got to pay attention and go for low-cost options. So, you've got the rules of the road. Now it's time to pick your car. Let's talk about a few common investment philosophies so you can find one that's the perfect fit for your own goals and, yeah, your personality too. But before you choose that path, you have to ask yourself a really honest question. What's your comfort level with risk? Seriously, are you someone who's okay with some big swings, those ups and downs, for the chance at higher returns? Or would you rather take a more scenic, steady route? There is no right or wrong answer here. It's all about what's right for you. This table kind of breaks down three of the most popular approaches. You've got growth investing. That's like trying to find the next big thing, right? Looking for those companies that could just explode. Then there's value investing, which is more like being a treasure hunter, searching for those hidden gems that everybody else has overlooked. And finally, you have index fund investing. This one's pretty cool. It's like instead of trying to pick the best ride at the amusement park, you just buy a ticket to the whole park. You get a piece of everything. Okay, so at this point, you have the knowledge. You have the tools. You get the power of compounding. You know the rules of the road. Now comes the most important part, actually putting that knowledge into action. It's time to take that very first step. And I promise it does not have to be complicated. It really just boils down to these 4 simple steps. 1, figure out your goal. What are you even saving for? 2, open an investment account. 3, pick a simple, low-cost, diversified fund. Remember rule number 1 and rule number 3. And 4, and this is so important, automate it. Set up automatic contributions so the money just goes in without you even thinking about it. That is how you get that snowball rolling downhill, for real. Look, if there is just one single thing you take away from all this, please let it be this. Do not wait for the perfect time to start. It doesn't exist. The absolute best time to start was yesterday. But you know what? The second best time is right now, today. Just starting, even if it's with a small amount, is the most powerful move you can make for your future self. So we'll leave you with this final thought to chew on. This whole journey to financial freedom, it just begins with one single step. It's not about trying to do everything all at once. It's just about taking that first step, and then the next one. So I'll ask you, what is your first step going to be? What's one thing you can do this week to own your future? The power, really, is all yours.